It's a big amount of money. It's a large amount of money in your trading account. Have you noticed a difference in how you feel going into positions, exiting positions, risk management approaches? Has anything altered?
Yeah, so I'm taking 2 weeks off and I'm not trading that account. So I haven't opened a single trade. I'm just waiting.
What is it that you have that is going to give you an edge over them? Now, that's hard to develop and it takes time to understand. But that's why I want to challenge you. Instead of just going, yes, I'm going to trade, I'm going to learn to trade, here's my money, let's click a load of buttons, do some research. You've got to be at the top of your game to keep it.
So I think I'm going to sell the bike. I'm going to take that money and put it in a margin call, and then that'll give me money to buy. This is how stupid me as a new trader was, because I was thinking like that money was going to turn into a new motorcycle. Well, guess what? That motorcycle didn't come that year. Okay.
Fantastic. Good morning, good evening, good afternoon, everyone. Welcome to TradeDelicious Live. My name is Jordon Mellor. It's an absolute pleasure to be in front of you guys once again. Super excited. If you guys can hear me, you guys can see me, make sure you make some noise in the chat as we get these energy levels up just a wee bit, guys. I can't believe I'm saying this, but they did it again. They hiked the interest rates again. Went against the analysts once again and created a lot of movement. To anyone that likes holding strandles or trades options, congratulations to you, because you would have just made a lot of money if you were trading the Aussie dollar during the announcement. Shock announcement, right? Come through and hiked interest rates once more. Very interesting. It's definitely not what a lot of people were expecting. Definitely not what I was expecting. Very interesting to see the market reaction. A lot of bullish momentum coming into the Australian dollar. Let's see how it unfolds. Did it catch anyone off guard? Did it catch any of you guys off guard? Were you in any positions and this just absolutely ripped through it? If so, talk me through your analysis and talk me through why you were still holding that position open during this time. But we can dive into that. Alexander, Russell, George, Grim, good morning to each and every one of you. I hope you're having a fantastic Tuesday. It's Tuesday today. We're slowly grinding through the week, right? It's Tuesday. One more day till hump day, then one more day till Thursday, and then guess what? Before you know it, we're at Friday. Isn't it simple maths? Simple. Looking at the trading day, yeah, really surprised that we had that Australian dollar interest rate hike. I can't stress that enough. I could have seen it come to fruition the last time out, okay? When we were having a look at it, what was it, from 3.6 to 3.85. I was expecting us to sit at 3.6 for a little bit longer. Would have been able to listen if we went to 3.85. That's what happened. What's interesting is when we were sitting at 385, I definitely didn't see 410 as an option. I did see a mixed reaction. We spoke about this this morning or your last night with Aaron in the new series of Daily Donuts, which is a new little trial series. So if you guys haven't seen it, go check it out. I spoke about that because I was in chat for that stream and we were talking about the fact that analysts were so mixed on whether or not we were going to come in at 3.85 or come in at 4.1. And there was such divide. That should have been maybe an incentive to look for the upper region given current economic climate. But very interesting. Didn't see that coming personally. Didn't have any trades. I'm still holding my Aussie dollar short. That's not changed. I'm still holding that. It is a long-term position, however. It's more of an investment position. But very interesting to see the way it's reacted of recent. Good Eve Sib. Hello. You're looking to buy euro and to close the gap? I'm assuming you meant to say euro Aussie dollar, but that is an assumption. Please correct me if I am wrong there, Grim. Russell, could the Aussie dollar just be making a reaction high before continuing lower? Look, potentially. I've just opened the wrong trading platform here. Bear with me. But look, when we hike interest rates, right, this is making us look very attractive when other economies are really looking to slow down these interest rate hikes. Okay, we're moving into an area where interest rates have gotten a little bit too high. We're going to see them start to come back in a little bit, and then money to flood into the equity markets and money to be flooding throughout the economy a little bit more. When you have especially a shock announcement twice on the dot, okay, twice in a row, I'll try and get it out. When you have that shock announcement twice in a row, different to what a lot of economists were forecasting, it's making the Aussie dollar very attractive to investors, because who's to say when we stop hiking these interest rates? Now, if you're a foreign investor, putting your money in an Australian bank account right now can really yield some fantastic returns, and being invested in the Aussie dollar as a currency because of these interest rate decisions, they can really yield some fantastic returns. So that's where you see a lot of the demand come in when we hike these interest rates, because for foreign investors, this is now more attractive than either the currency they're currently using or any other investment in which they have. This is starting to yield better returns, and that's why you're seeing the demand come into the Aussie dollar. I wouldn't see that necessarily as a as you said, a reaction high before continuing lower. Maybe if you look at the longer term charts, we can pick it apart technically, but purely looking at the fundamental reaction and purely having a look at what actually happens when these interest rate decisions are made, it is going to be an increase of demand, which we might see over the next few days. Realistically, we might see a continuation. Keep in mind, we do have the GDP coming out tomorrow. Tomorrow morning, it'll be about, I want to say about maybe 15 hours from now. Is that right? Yeah, I'd say about 15 hours from now, we have the Aussie dollar GDP. That's going to obviously move the Aussie dollar a little bit more, maybe alter some of these longer term positions which people are adjusting to and moving towards. So we have to keep an eye on that. I saw the movement, but I was sitting it out. Well done, Alexander. I'm trying to avoid trading an hour before or after major news or data because I seem to really struggle around those times. Great decision, Alexander. It's because no one has any idea what is happening. You can be a seasoned veteran analyst. You can be a day trader that makes $15 million a day. I don't care. No one knows what's happening. Unless you have insider information, no one knows how the charts are going to react or what that data is going to be. It is a really, really smart decision to sit those ones out, especially if you're a bit more of a short-term trader and your positions are a little bit larger than what the longer-term position traders will be. Your stop loss is a little bit tighter. It's definitely better to avoid those altogether, right? Just don't mess with them. It's definitely the best decision, and I'm proud of you for making that decision. It is a good one. Based on the Australian bank rules, serviceability will now be assessed based on 9%. Yeah, it's pretty nuts. I did see a bit of a an interesting statistic come out that if you had a $500,000 mortgage, this is Australian dollars, okay, $500,000 mortgage in May 2022, you're now paying an extra $1,200 a month, an extra $1,200 a month on the exact same mortgage. That's how our interest rates have moved, and that's how it's really strangling the mortgage holders and removing the money from the market, which is what it's attempting to do. But yeah, an extra $1,200 per month in just a year, bang, you're looking at paying an extra 15 grand a year in mortgage. So I definitely expect this to impact the housing sector, shall we say. I definitely think it's going to revoke a lot of demand. I don't think people can walk in there. So average house in Melbourne is well over 800K. Exactly. The housing here in Melbourne is ridiculous. If you're dead, you can get, I don't know, roommates. I think that's what they suggested people to do. I think Governor Lau come out and said, which is some really good advice for you if you are here in Melbourne. It's a really good way of, these higher rent prices and mortgage prices are going to be really good for the current generation to re-economize, I believe his words were. So essentially, he's telling the general public to cop it and adjust, which they need to do. right? They need to do. The reality of the situation is housing market is way too inflated. Young people can't get on the market, and this is just reaffirmed that young people aren't going to be able to get on the market for at least another 5 years, if not longer. So if you're young and you're in Melbourne, sorry. There's nothing more I can say, right? I'm not going to try comfort you because guess what? I'm young and I'm in Melbourne. I'm one of you. But yeah, very interesting circumstances. Anyway, let's get back into the charts. You guys are here to talk about trading. Euro, Aussie dollar, that is what you were talking about. Let's have a look at it. Let's first of all, as we like to, that was ridiculous. Council bloody don't allow more rooms without permit. As we do, guys, let's have a quick look into the heat map to have a look at how assets have been trading so far today. Aussie dollar obviously bringing in that strength with the RBA rate decision of 25 basis points. Japanese yen trying to push up a little bit higher, just not as strong as what the New Zealand dollar or the Aussie dollar can do today. Canadian also looking to push just that wee bit more. It is interesting to see the commodity assets are really what's trying to move up here. Sterling's being stumped early morning. US dollar's been pretty mixed. Nothing to write home about when we're looking at the US dollar. So it's very, very interesting. My mortgage in Japan is still less than 1%. Yeah, are you still being paid for those mortgages yet, or you still have to pay? I thought you'd be getting that rapid cheap, but no, yeah, it is interesting. The Japanese yen situation, well, not the Japanese yen, the Japanese economy situations are one of great interest to me because while we've had this global money supply issue, it just seems like it just hasn't hit Japan, which is really interesting to see how we can. Can you provide me a loan? I'm happy to give you a 4%. Hey, that's not bad. That's not bad. But it's really interesting to see how the situation's unfolding there, especially Russell. I'd love to chat to you someday about what it's like living in there at the moment economically, because when everywhere it's really struggling to handle inflation and really handle the money supply that everything's getting, it just doesn't seem to be happening in Japan. And what's really interesting is Japan has just been nominated to be in a stagnation state, while the rest of the Asia Pacific region, excluding Japan, is actually in an up and coming market. It's actually looking a little bit more green compared to the rest of the world that are looming in that recession status. So it's really, really interesting to see Japan just be such an outlier in the matter, and it does get my interest. Just peek it a little bit. I do need to have a chat to a couple of different experts in that area and figure out why this is the case and what we can learn from it. Aussie dollar and Canadian. Aussie dollar looking to sell the Aussie dollar, but only in the short term. Grim, you're looking to short the Aussie dollar based on that data that just came out. That's a questionable decision, good sir. But don't let me interrupt you or move you away from your analysis. But I do think we usually see, especially with a shock announcement, we do usually see a continuation for a few days, maybe even a couple of weeks. Keep in mind GDP data coming out tomorrow. Okay, that's still going to be a big reaction. I think a lot of people are going to be taking their profits from today into tomorrow, regardless of what that GDP announcement can be. That can give you incentive that you may actually see some short selling coming in the Aussie dollar with the GDP liquidity, but we'll see. There's only one way to tell, and that's we'll see. My prediction would be yes, we're going to see some short side selling regardless of that GDP announcement. I think we're going to see a lot of people taking cash out of the Aussie dollar just to cash in their positions that they've made today. However, I am not putting money on that, and I'm not going to stick to that. And I do ask that you don't stick to that, because that is just a mere prediction. And if I was right all the time in those predictions, I would just be making money on it. Okay, I wouldn't bother. That's pretty much how it sums up. I've been sticking to just Euro US dollar until I can get more consistent and limit my tendency to overtrade, but looking for an alternative pair that doesn't contain either of them. Any suggestions? You don't want to trade the US dollar, you don't want to trade the euro. That's interesting. I would have thought you'd be more inclined to trade an asset that did involve one of the two currencies, which means there's less analysis that needs to be done. Only 3 assets rather than 4, so it's interesting. It goes for all young people around the world. It sure does, Nikita, excluding Japan. Yeah, I've got a weird feeling there's going to be a mass migration to Japan. What do you guys think? I mean, I like snowboarding. They've got Suzuka Formula One. I'm in. I like Japanese food. Russell, how many rooms do you got? Can you fit a TradeDelicious community by any chance? But no, I do think you're going to see a lot of migration. I think you're going to see a migration generation of people moving to where it's more affordable to live, because the really sought after areas where people want to live, they're a bit. Don't take my words for it, Grim. Prove me wrong. I really ask you, just go and prove me wrong. Stick to your guns. Stick to what you know, because I don't want to curb your analysis. I just think it's a bit interesting. I just think it was a bit interesting, and I wanted to ask about it. But yeah, going back to you, Alex. When you have that tussle of trying to find a new asset that you want to bring in, you've got to have a look at what the assets you are trading. You're already trading the euro and the US dollar, okay? So you're already going to understand these a little bit more on a price action standpoint, but also from a macroeconomic standpoint. If you can just add one more currency pair, I mean, you're going to get two new pairs to trade, but also you only have to analyze one more economy. So if you want to just go completely out of the blue, you got euro and you got, if you got euro and you got US dollar, and then you want to pull in sterling and Swiss franc, okay, cool. But now all of a sudden you've got four economies on your board, which you need to understand in order to trade. Excuse me, gassy. So I would have thought you would want to just bring one in, maybe the pound, maybe the Japanese yen, maybe the Aussie dollar or something like that. I always like trading the Aussie dollar, but I'm here in Australia. It's easy for me to do so. It's easy for me to understand. I'm surrounded by what's happening. I see that as a bit of an edge when looking in the Aussie dollar. Let's get into the charts, because I know you guys are itching for it, okay? I know you're itching. I can feel you guys sitting there scratching, saying, Jordon, show me your chart. Show me what you're talking about. So let's get into the charts. Euro, Aussie dollar. Who was it that was asking me about Euro, Aussie dollar? Grim, I know you're looking to sell the Aussie dollar, but I'm sure someone earlier mentioned, no, it was just Grim. It was Euro, Aussie dollar all day, looking to sell the Euro, Aussie. I really don't want to do analysis on any Aussie dollar pairs, solely because we're trading macroeconomics. We're not really trading price action. As you can see, this does not scream price action, okay? A trend line break didn't cause this. No, this was the RBA rate decision. I always love that. I see a lot of people on, we're being a lot more active on Twitter and a lot more active on TikTok and everything like that, especially at TradeDelicious. And I love seeing some of these education providers live streaming or whatever they might be doing, and macroeconomic news hits the market and it sends it absolutely haywire, and then they break it down. They say this happened because of my support area here or my supply area here, or it's like, no, this happened because the RBA hiked 25 basis points. It honestly tickles me every single time I see it. But make sure you guys understand what actually is moving these charts, because it's really important. You're in for 1% interest rate. I'm always in for a 1% interest rate, as long as it's when I'm loaning and not when I'm investing, because if I'm only getting a 1% yield, I'm not very happy. The population is lower. It is, but it's similar to like Australia, right? What's the Japanese population? You got 125 mil, and I think Australia population is like 30 mil. Yeah, we got 25 millions. Yeah, so you've got 125 million. Australia's only got 25 million. So population density is still there, considering Australia is going to be maybe 10 times the size of Japan. So I wouldn't worry too much about that. That makes sense. I just didn't know if you would limit opportunities, but that makes sense. I get what you mean, because you're looking at correlation. Okay, and that's where your head's at, Alexander. You're thinking, okay, if I want to completely break away the correlation from these assets in which I'm trading in order to analyze this new asset. A couple of things I want you to do. Test your strategy on the available pairs, all of them. Yeah, it's going to take time. It's going to suck. It's going to take a lot of hours and a lot of manual labor, sure. But I want you to test it. I want you to test it on all of the available assets and then just trade the ones that yield the best return. It's the best way to go about it, realistically. Whether you want to look through forward testing, you want to trade all the assets and then have a look at your statistics, don't recommend doing that. I'd recommend more looking at back testing and looking what your strategy can approve or achieve. But that's a great way to have a look into it, and it's a great place to start anyway. What else were you looking at? Aussie dollar CAD, I think someone mentioned, which we're seeing CAD mixed reaction. We're seeing a little bit of strength from the CAD. Obviously, when we're paired against the US dollar, it's not going to be ideal, but if we're paired against the Aussie dollar, if we have a look at against the US dollar, you can see the mixed reaction, the actual strength that we're having the CAD. And what's really, really interesting is at the exact same time the RBA hiked their interest rates, you can see the demand come into the Canadian dollar, and you're going to see a very, very similar circumstance also on the New Zealand dollar as well. You're going to see the exact moment the RBA hiked interest rates. Reserve Bank of Australia hiked interest rates, and the Canadian dollar was increased volatility and really moved. The New Zealand dollar increased volatility and really moved. It just shows the economic ripples in which we can have when we have these shock interest rate announcements. Well, you're seeing a lot of people jump into safe haven commodities. And these commodity currencies like the Canadian dollar, the New Zealand dollar, the Aussie dollar, these are great little ones to jump into. Can you suggest backtesting tool that have a volume indicator? I bought Forex Tester, but it doesn't have a session volume indicator. I'm not sure, Sid. I've always done my backtesting manually, the hard labor way, right? Sitting there and actually going through and marking down what happened, taking screenshots. I've always done it that way, and it's probably how I'll always continue to do it. But maybe I'm old school in that fashion. But the whole seeing it and planning the trade and trading it definitely is how I like to do it. Any tips on how to go about backtesting a mainly macro-based strategy? That's real tough to do, Rick. That is arguably one of the hardest things to do, if not near impossible, backtesting macroeconomic strategies. If you're looking at trading macroeconomics, it's definitely going to be a reactive or forward testing basis. It's not something you can really backtest, because especially already knowing what happened, but the exact time and events that different things changed that hinted at what was going on, really, really tough. And then when you're trying to look at merely just one macroeconomic side, like let's say you're looking into the GDP, you're going to be cross-referenced with so many other economic decisions which infiltrate that and affect the value of the price, the value of the asset. So backtesting a macro-based strategy, tough unless you're looking at things like seasonality or more broad, I guess more macro side of things. But yeah, in terms of backtesting the strategy technically for a macroeconomic purpose, I don't have much help for you. You're better off forward testing. If you find a way you can do a video on the TradeDelicious channel, you can, Rick. You can by all means have an hour explaining how you went about it, because to find accuracy and statistics based on doing it that way, I'm not too sure. I've definitely always just been a forward tester when it come down to my macro strategy. Excuse me, I'm just gonna take a quick drink here. And just for everyone, that is water. Okay, that's not vodka. Aussie dollar's going to drop. Oh, you're so addicted to this Aussie dollar, aren't you, Grim? It's just grabbed you and it's saying, dude, trade me, trade the Aussie dollar, trade me. No, I know the feeling, but no, I'm unsure. We'll see. We've got GDP tomorrow. Where are we sitting? Cash rate coming at 4.1. Yeah, we've got Governor Lau speaking at 9:20. He's going to talk us through exactly why they've made the decision they've made and why they've actually hinted that we may have more interest rates to come. And then we've got the GDP, the quarterly GDP, which is expecting a little bit of slow from 0.5% down into 0.3%. So we'll see. We've also got the Chinese trade balance, which does actually infiltrate the Aussie dollar just a little bit because they're our largest trade partner. Excuse me. Yeah, no FOMO. Yeah, it's interesting, Grim. It's interesting. Looks like I'm chatting too much. Oh my God, Sib, that is not a thing. Please talk more. There's nothing I like more than when this chat is constantly flowing and you guys are asking questions and we're having a conversation. It's the reason we do Trade Delicious. It's so we can conversate and be a community. So please never stop yourself from chatting X amount. I can assure you, it's exactly why we're here. Pick up brain. If someone doesn't like it, they will just ask a question that they want answered. That's the beauty of Trade Delicious. Can I include the Trade Delicious Twitter handle when I post charts on Twitter? Absolutely, Russell. Tag us in it, ask us questions, ask us comments, whatever you want to do. Tag us as much as you like. I'll be active. Okay, I'll see it and I'll be able to talk to you through there. Good day to you all, Mr. David Brewer. I hope you're having a fantastic day. David, I did send you an email. I did send you a code to get a free ticket to Traders Day Live if you wanted to attend and meet us in person. Make sure you check your inbox. I did send one over to you. Just technically speaking for now, any trade. Yeah, technically speaking, I can see the attraction looking in the Aussie dollar, but I'm not too sure. Okay, then when are you flying to London? I'm jealous of you. I'm flying on Sunday, this Sunday. So that means next week it's going to be predominantly Aaron here on the live stream. I will try my best to join at some different points, but I'm going to be the other side of the world. While it will be in the best time, I'm going to be staying with family just for a couple of days. And I think it's just going to be quite interesting trying to join a live stream when I'm going to be surrounded by family I haven't seen in years. So we'll see. We'll play it by ear. But for now, you can expect Aaron to be prominent and doing some live trading rooms with you guys in the morning coffees. But I will try and pop my head in here, there, and everywhere. And then we're also going to be live streaming the entrance of Traders Day Live to show you guys who aren't able to attend just what we're looking at early on. And then hopefully we're going to have, well, not hopefully, I've got it planned. We've got heaps of interviews and panels and everything set up throughout the day, which we're going to be recording and then later can edit and upload so you guys can see a lot of the content that we've done and attend the next event. We can show you guys exactly how fun it is and why you need to be attending these type of events. Good morning, Mr. Brewer. Loved your video. Good job on what you do, my friend. Well done to you, Alexander. David, I hope you like that kind message from Alexander. Lucky guy. Yeah, I'm looking forward to it. I mean, I'm not looking forward to the flight. The flight's going to suck, but it is what it is. It's how we get to the other side of the world these days. Hopefully we'll bring back the Concorde or something without the loss of life, and we can attempt to get over there a little bit quicker than what we usually see. But let's see, shall we? Let's see. Let's have a look here. I've just accidentally changed that. I didn't mean to do that. Let's jump back in. Let's have a look at how our indices are going today. S&P 500 had a rather mild day. Sideways trading could be a really good opportunity later on. What I really want to look at here is the fact that the Aus 200 has been absolutely stumped on the decision for these interest rates to come up. Next one close to Australia. Sib, I'm thinking, because Trade Delicious, we've got quite the Australian community, surprisingly. No, I'm not flying with Qantas. Although Qantas is a fun one to talk about because I've been a shareholder of Qantas for a very long time, Sib. It's something I've publicly spoken about. Right, let's not look at today, okay? We had the RBA interest rate hike. Let's just, as investors, let's just not look at today. But as a whole, I'm really liking Qantas as an investment. I scaled in these black lines down here, scaled in around the 450 mark. We're now trading up at 635. That's post RBA announcement. Trying to push our all-time highs into 750. I really am thinking about continuing to load up on this because Qantas is providing me some outstanding returns, but also it's a great company, which I really do believe should be valued a lot higher, up towards the $10 mark. So it's going to be interesting to see how this plays out. But considering we're normally day traders, here I am talking about investments. Qantas, SIB, is something that I've been invested in for a little bit. And I know so many Australian businesses just exclusively fly with Qantas as well. And as Australia's population booms, I definitely can see Qantas becoming bigger and bigger and bigger in the grand scheme of international travel. Great British Pound, Japanese Yen sell. Now we're talking about something that doesn't involve the Aussie dollar or the Australians at all. I don't think Tathagata, I was right the first time, likes Australians. No, I'm just kidding. Why are you looking to short Great British Pound Japanese yen? It seems like it's already on the move. What's really standing out for you as a short option? I'm intrigued. Talk to me. Do you not believe it's going to be a little extended? Is there a macroeconomic push that's leading you to want to short this? Talk to me. I want to understand your analysis here. I want to understand what's gone through your mind in order to make this decision. It always intrigues me how traders make their decisions, and this is one of the decisions I want to get a better understanding of. Divergence in the daily time. Excuse me. So you're looking more long term. You're looking to short the pound. Divergence in what? We've got a small divergence in volume. That's right. If that's what you're looking at. We do have a bit of a divergence push in the volume. The pound, I mean, we can see interest rates maybe continuing aggressively for the pound, right? Japanese yen, like we discussed, you can ask Russell, maybe not so great in the outside investment scene. I'm not going to say no, right? Because you never say no. I've got no idea which way this chart's going to go, but it is going to be an interesting one to see where we can move. Guys, Aaron's been really, really generous to talk to us about ISM manufacturing PMI. You would have seen yesterday we did have the the ISM services PMI come out at 50.3 rather than 52.6. So feel free to stick around, okay? I'm going to leave you with Aaron for just a second. There's a minor echo right at the start of this video, okay? Just bear with it. It's very, very minor, and it will disappear within about 4 minutes, if that, okay? So stick with me, enjoy this video, and we'll be back straight afterwards.
Good morning, good evening, good afternoon, traders. As always, thank you so much for joining us here at TradeDelicious. I'm Aaron. I'm super excited to share some more educational content with you guys to make sure you have a full understanding of what's going on in the economy at large. I know there's a lot of charts to look at. I know there's a lot of news to get through, so I'll hop right into it. The subject of the day is ISM non-manufacturing PMI. That's a mouthful. Usually it's referred to as ISM PSI, ISM services PMI. Say that 5 times fast, right? They're basically surveys. It's a collection of surveys that are sent off to purchasing managers in 19 different portions of the services sector. The services sector being a massive part of GDP here in the States and in countries across the globe. Now, this is different than the IHS Market PMI. That's a very, very similar product that's produced by another nonprofit, but they focus primarily in international markets. They do produce a PMI, services PMI, for here in the States as well, but the ISM non-manufacturing PMI seems to be the gold standard for us here. This report is really generated from a survey, as I said, and it creates a composite index from the answers on that survey in order to measure the strength of the services sector here in the US. The data that we're pulling from in this case all comes from the Institute of Supply Management. Again, it's just a nonprofit that puts together a lot of these types of numbers for use for companies across the globe focused on the American market. What is included in this survey? This picture really gives you a good idea. You have survey data that is collected by way of asking a question and then having the purchasing manager specifically click one of the 3 answers offered to him or her. The answers that they could have is one of 3 different kinds. They can either have increased, unchanged, or decrease as their answers, or no change now. Or it could be better, worse, or the same. So basically the same. After all of these surveys are collected and then sent back to the ISM, they put everything through a diffusion index and add it to a scale that is between 0 and 100. Anything over 50 being expansion, anything below 50 being contraction. Consider that as we continually talk about this product here. It's always really important to go over the basics. I think sometimes when I'm talking to people about this and going over goods and services, sometimes we forget that not everybody took economics in college. Not everyone here even has a college degree, and that's perfectly fine. In order to trade and do well, you need to be good at trading. You need to be good at understanding what's going on in the markets. That's why we're here to help you, right? So, super quick overview. What is a good? What is a service? When you're getting your tires changed, say you need 4 new tires. My wife, she has a 14 Corolla we just got 4 new tires for. When I bought the tires for, the tires themselves were the good. The guy I paid to put the tires on, he was giving me the service, right? So remember that as we move forward, services are really tasks performed by a business for a price, whereas the things like the goods are the tires that go onto the product, in this case, the car. Services as a part of GDP is a huge deal. We're looking back at our friend Fred. This is what a great tool. If you ever get the chance, please take a look at it. From the St. Louis Federal Reserve, they have a ton of incredible data. This is showing what things were like from 2006 to today. And it shows that in 2006, we had some decent numbers. We were a little closer to, say, 11.1% as a portion of GDP for the services industry. Now, services represent 13.1% of US GDP. That's one of the reasons why ISM Services PMI is so important. Now, for the headline number. The headline number in this case really just measures the economic health of the service sector as shown by a percentage between 0 and 100. We've already gone over that a little bit. A reading over 50 is great expansion. A reading below 50, generally speaking, is bad. It means it's contracting. There are 4 parts that are looked at in order to create this top number here. Those 4 numbers being from business activity, new orders, employment, and supplier deliveries. That's how things are broken up into the survey. These four items all play a role in getting us this services PMI. Keep that in mind. Let's look at a quick breakdown to further understand what's going on here. These are the figures that were reported for May 3rd. So this is a leading indicator, but it's talking about what happened in the previous month. So this is the data from April. We had a read of 51.9% versus a forecast 51.8%, really close. Usually economists are like weathermen. It could rain with 100% certainty, or it could not rain with 100% certainty, right? It's always kind of up in the air, so it's always impressive to see them get the numbers right. In this case, this number means that the sector is growing slightly faster than expected, and the additional data that we see is mixed, but things like inventories and new exports stand out. All of these items can mean totally different things depending upon the product that you're trading. If you're trading the US dollar, for example, you want to see things like new export orders not growing 17.2%. This could potentially be bad for a currency because companies could be diversifying their client base. Why would they do that if they're doing so well here in the States? Well, there might be a concern that the Federal Reserve would cut rates, for example. If rates get cut and inflation goes up, the value of the dollar goes down. So it would be in the best interest of a company to go ahead and invest in clientele elsewhere across the globe. So new export orders is something interesting that I'm seeing here that potentially makes this less of a expansion conversation, a positive conversation from an economic standpoint. Another thing to look at is inventories. If inventories are falling, that means that they're selling. That means that the purchasing managers here are excited about selling because they are seeing less inventory. They're getting their stuff off of the shelves. That's really great from an expansion perspective. That's something that we really want to see, inventories contracting in order to expand on profit margins. This is something that's really great to look at if you're trying to make a play on the manufacturing sector. Stocks like Home Depot, Honeywell, Procter & Gamble, as I spoke about before, are going to be big players in this area. So if we continually see stuff like inventories falling and business activity growing, then more money is going to be made. Let's look a little bit further into how to analyze this stuff. Always remember that the interpretation of this data depends on the current economic conditions. Here in 2023, things are a little different than they were in 2007, and vice versa, right? These surveys are leading indicators, meaning that they're setting an expectation. They aren't the real deal. We have some real data that comes out from the U.S. Bureau of Labor Statistics, as well as the Bureau of Economic Activity from the U.S. government, that gives us a very clean idea of what's happening in the manufacturing sector. This is just giving us a sneak peek, and it helps investors and business owners, traders, to plan and anticipate the numbers that are going to happen. It's one of the reasons why we use indicators, one of the reasons why it's such a big deal. A lot of people feel like it helps them get a leg up on the competition. Always focus on the bigger picture and remember what lens you're seeing this through. It's sometimes hard to understand which way is up from that perspective because, normal economic conditions, expansion's great, more money's great, and contraction's bad, less money's bad, right? Sometimes. Especially when we're seeing mixed figures like that report that I just showed you guys, where you had things like inventories going down, but new export orders going up. That could be really great for Honeywell as an individual stock if they're diversifying, they're selling their stuff. But that may not be great from the perspective of a currency trader. An equities trader would be able to grab onto some of those gains potentially by buying some manufacturing stocks or a manufacturing index, whereas someone who's trading the US dollar could also benefit by doing something like buying the pound dollar or shorting the pound yen, something along these lines. Remember that there are so many different ways to approach these things depending upon the asset that you're trading. Let's look at a couple examples to get a further understanding on how it affects economies as a whole, though. 2010 is an interesting year for us here in the States because we're coming out of the craziness of 2008, 2009, and we're starting to recover, right? So a positive and expanding ISM services PMI would be great. That type of growth is what we would need at that time because we were a country trying to get back into the saddle after the craziness of 2008. In contrast, let's take a look at 2023. What's the focus right now? Inflation. If anything grows, if any business activity grows, generally speaking, inflation also grows. So what will we see if PMI continually grows, services PMI continually grows? We'll see the Federal Reserve take action. If the Federal Reserve takes action by raising interest rates, that'll make money more expensive, that'll make it more difficult for companies to spend the cash they want to spend to expand. People will lose their jobs, and the economy most likely will contract. In this case, of course, all those things are incredibly negative, but from an economic standpoint, the US dollar would grow stronger in this scenario, even though we would be experiencing potential contraction from the Federal Reserve's actions. This is the same situation from an economic standpoint as 2010 when you're solely looking at whether or not an economy is growing from a positive or negative ISM services PMI. In this case, a positive PMI means we take very little action from someone like the Federal Reserve. They're not caring so much in 2010 about this issue. They're trying to get people jobs. They're trying to make sure everything is stable. The Federal Reserve in this case is taking the absolute opposite perspective, and they're causing the economy to potentially shrink, GDP to potentially shrink. But in both cases, the US dollar goes up in value. Remember that as you're thinking about how you can potentially take advantage of things by way of using these events to further understand the macroeconomic landscape. Every report that you see is a part of a much larger whole. Boom! That's really all I have for you. Thank you guys so much, as always, for watching these. We love to share everything that we know with you guys concerning the economic situation, the macroeconomic situation in the world, and we hope you got some value out of that. As always,
Aaron, once again, an outstanding video to teach us a little bit more about macroeconomics. I've got a question straight off the bat. We saw the ISM Services PMI released yesterday. What was interesting is we come in above 50, right? Which is technically still market expansion. But what's interesting is we saw a huge sell-off in assets. An asset in particular, like US dollar, Japanese yen, we were dropping 0.6% in a matter of minutes. Why was this the case?
Right. And you're exactly right. After the news printed, the US dollar was sold off in a variety of different ways. I mean, it was a huge miss, right? And what does that miss mean in our current economic space? The Federal Reserve is very interested in looking at this number because, like I said in the video, they're very interested in figuring out, are interest rates being raised so quickly working? A 50.3 print versus a 51.9 expectation shows that although there is expansion, that expansion is slowing, and it's slowing very quickly. The Federal Reserve is likely going to be okay with that. Many analysts believe that this means there's less of a chance that the Federal Reserve is going to be raising rates with the next Fed meeting later this month. In fact, the CME Federal Reserve interest rate tool, that basically it's a percentage guess on whether or not the Federal Reserve will raise interest rates, dropped quite significantly to about 22.9% now. So there's a 22 or 23% chance that the Federal Reserve is going to raise rates. If news like this continually prints where we're missing to the downside, that number will continually fall, therefore hurting the US dollar as we don't raise interest rates.
It's
Or
interesting
ratchet.
to see because we've seen, especially of recent, I've been talking about it all morning here on the live stream, is analysts were predicting us to sit flat the RBA rate statement. We talked about it in Daily Donuts this morning, the real mixed reaction. We hiked once again. That's twice on the trot. We've had a shock, and against the majority vote that words that economists are talking about, against the
Right.
majority vote, we've had this shock announcement, and we've seen it ripple. And this is something I was talking about because we've seen the Canadian dollar move because of this, the New Zealand dollar move, the commodity assets really move. And what was interesting is we were just having a discussion is this services PMI, it rumbled gold. We've seen a lot of
The
traders rush to get into gold on the sell-off of the US dollar. It's interesting to see. The initial reaction can tell us so much about what traders are thinking and where they're going to go during different times. So is this a bit of an incentive? This is a tough question. I don't expect you to actually have the answer for this, okay? But it seems like this is a little bit of incentive for people to maybe get back into gold.
Absolutely, absolutely. In my opinion, I'm not the biggest gold fan right now, especially after we haven't seen a real pullback in my eyes from the all-time highs that we've been trading for the greater majority of the year. But it's natural for people to want to flee to this kind of product because there are so few products that are even positive on the year. We talk about it all the time on the channel, where the S&P 500 is really being held up by six stocks. Six stocks are performing positively. Everything else is just trying to breathe, just trying to get air. There's very little market breath, pun intended there. So if investors can't find much help in the S&P 500, there isn't much market breadth there. Why not flee to something like gold, which has over decades, hundreds of years, we've placed this value in gold. So if the US dollar isn't going to continually raise in value through interest rates being raised to the Federal Reserve, why not put my money in something like gold, especially when it pops so aggressively on a news event that in reality is kind of important, but let's face facts, it's not the most important event by any stretch of the imagination. So if we see this kind of pop off of non-services PMI, what happens if we have a negative NFP and then in the coming weeks? Then we'll really see investors start to pile into a product like gold. And I couldn't blame them.
It's exciting. I know it's horrible to think about the different moves and the different assets going down and whatnot, but we're traders, all right? This gets us excited. We're talking volatility. We're talking clues into what some serious moves and serious volatility. There's a lot of traders in the chat that were talking to me a little bit earlier about longer term positions in the US dollar. Are you hinting there, Aaron, that there may be some value in starting to look towards the downside in the US dollar?
I would love to say yes. I have absolutely no idea.
That's a great answer. That's the answer I wanted.
Right. So I've always been very interested in trying to establish longer term positions in the currencies, but with everything going on right now, it's been difficult for me to do so. In my experience, um, I've been much more confident in the currency pairs like the which is ironic, of course, because we're talking about the U.S. dollar. But I've been very, very interested in opportunities in the pound dollar, for example, because we've seen the Bank of England has had a really tough time getting control of this inflation situation, and the numbers for the U.S. that have come out have continually been better and better and better. So perhaps there's some opportunity there, perhaps not. But the reality of it is, we have seen some real changes here. The VIX has fallen below 15, which is insane, meaning that volatility from a market maker's perspective is falling considerably, and we're starting to settle in. Most things are being priced in. If we start seeing things like big misses or big beats from other news events that cause more in the way of volatility, then we can start to have more of a conversation. But right now, I imagine it's going to be more of the same moving forward. We'll see what happens after the Federal Reserve has their meeting later this month, but that's where I'm at.
It's a classic, another year, sell in May and go away. Everyone's buckling in, getting out of
Yeah,
there, going to the beach for summer. I mean, we're buckling in for winter here in Australia, but
right.
it does just seem like hibernation period is well and truly hit home in the financial markets.
It has, and in the past 20 years, we've really never seen June perform incredibly well. It's always one of the worst performing months over the past 20 years. It is the second worst performing month in the U.S. markets. So I'd be remiss to not mention that, and I'd be surprised to see anything different.
Yeah, fantastic. Little birdie told me you enjoyed your new little series of daily donuts this morning. How did you feel it went?
Yes. Oh, it was great. We had a lot of fun looking at a lot of different kinds of markets, talking about a collection of different trade ideas. Saw some familiar faces, saw some new faces there. Thank you guys so much for joining us. And it's going to be exciting moving forward too. As I said before, it's a brand new thing, so the format's going to change a little bit here and there. We're going to be trying a couple different ideas of how we present this information to you guys, but I think that we're able to bring a lot of value through Daily Donuts, trying to find what's sweet and what's sour in the markets. Don't quote me on that. I'm still trying to get
I
a line.
love it.
Still
I
trying
love it.
to still trying to get a line for it.
It is fantastic. Guys, if you missed the live stream with Aaron, well, my this morning, your yesterday after market close, feel free to go back and have a watch of Daily Donuts. And of course, you're going to be doing it again tomorrow for the lovely people, where you're actually going to, rumor has, especially in current events, you're going to be talking a bit about OPEC.
Yes. That's another part of this whole currency conversation. Oil is so connected to so many different currencies. Maybe not so much the U.S. dollar, but definitely products like the Canadian dollar, right? OPEC decided, surprise, surprise, more cuts are on the horizon. Saudi Arabia said, the price is just it's too low. We're not, we're struggling out here. We only bought 3 Lamborghinis last month. It's not going well. We have to cut production by 1 million barrels a day. And they've, we'll talk about it a little bit more tomorrow, but it's a crazy situation out there with oil.
Fantastic. Aaron, an absolute pleasure. Everyone at home, I want to thank you for joining today's live stream. If you did enjoy it, make sure you've hit that like button, leave us a comment on your thoughts, and be sure to join us at the exact same time tomorrow. Alan, I'm going to let you do the honors.
Thank you guys so much as always. Trade well out there and trade delicious. Thank you.
What is it that you have that is going to give you an edge over them? Now, that's hard to develop, and it takes time to understand. But that's why I want to challenge you. Instead of just going, yes, I'm going to trade, I'm going to learn to trade, here's my money, let's click a load of buttons, do some research. You've got to be at the top of your game to keep performing.
So I think I'm going to sell the bike. I'm going to take that money and put it in a margin call, and then that'll give me money to buy this. This is how stupid a new, well, me as a